Hello friends, welcome to the Manthan series of BFM. In Manthan series, as you know, we are covering all the subjects of CIB, all of them. ABM, BFM, ABFM, BRBL. All the previous year questions, numericals, case studies, objective questions, everything is covered. So follow the series till the end. Watch all the videos. Subscribe to the channel, click on the bell icon. Watch this video till the end because today's topic is very important. Liquidity management in banking, in treasury basically. Very important topic. How to manage the liquidity. Liquidity means daily problems, daily cash which you should have. We'll discuss in more details. Let's move ahead. Which of the following is the primary objective of liquidity management for a business? Now see, business. Here we are not talking of bank. Business. After all, what is bank? Bank is also a business. Bank is net a business, isn't it? So, same rules which are applied to the other businesses, same will be applied over here also. So, which of the following are the primary objectives? So, what are the primary objectives? Let's see. Maximizing profits, minimizing cost, ensuring the ability to meet short-term financial obligations, optimizing long-term investments. Or E I'll give you, one more I'll give you, E. All of the above. The above. Let me see how many of you answer it correctly. E also I have given. Maximizing profits, minimizing cost, ensuring ability for short-term obligations, and optimizing long-term investment, and all of the above. Let me see. What I say? Many of you have typed this E answer. But the E answer is wrong. All of the above is not the answer for your liquidity management. Liquidity management is only about short-term obligations. Ensuring the ability to meet the short-term obligations means I have to pay the EMI next month or this month. I have to see that the money is received for that. I have to pay to the depositor maturing tomorrow. For that I need to have money from the loans, right? This is how it works, right? So, kindly note, the primary objective of liquidity management is not maximizing profit, minimizing cost, optimizing long-term. Long-term is out of question for liquidity. Liquidity is mainly concerned about ability to meet the short-term financial obligations. Okay? So, in exam, they will trap you using all of the above. Not the answer. Okay? What does liquidity refer to in financial context? Financial context. The ease at which asset can be converted into cash, the solvency of a company, the overall profitability of the business, the ability of long-term funding, and E option I'll give you, E. Okay, one more option I'll give you. Now, I'll again put a trap. Let's see. A, B and C. A, B and C. Okay. A, B and C. Okay. Let me make it proper. A, B and C. Okay. So now, check this. A, B and C. So obviously by now you might have got the logic that answer is A, B and C only, between that only. Ease at which, with which the asset can be converted into cash, solvency of a company, overall profitability of the business, availability of long-term funding. Just now I told you, it's of no use. So D is out. E is A, B and C. So what do you mean by liquidity? Yeah? What do you mean by liquidity? The answer is A. The ease with which the liquid assets can be converted into cash. That is A. That is the answer. Solvency of a company is different aspect. Solvency depends on many other aspects. It's not only liquidity. It includes long-term aspects also. Long-term solvency and short-term solvency. Both of them are included. Solvency means if the company is not solvent, it means it's a bankrupt company, insolvent. Okay? Overall profitability, that is not a part of your liquidity. That is a part of your ratio analysis. Ratios. Overall profitability. That's a part of your profitability ratios. Okay? So the answer is A. The ease with which an asset can be converted into cash. Suppose if I am having any asset, let's say any inventory. If it can be converted into cash immediately, then what? Then it's a liquid asset. If it can't be converted, then it's a dead asset, isn't it? It's a dead asset then. Got this point? Okay? Next. Which of the following is the key components of liquidity risk? Key component, important component. Credit risk, market risk, operational risk and funding risk. Key component of this liquidity risk. Very important point. Now, one thing I'll tell you in this. Okay, let me get the answer first. The answer is, what is the answer? The answer is funding risk. Funding risk is a key component in liquidity management. Isn't it liquidity risk? Why? Because, see this, what is liquidity? I must get right time, right money, so that I can pay to the whoever are the depositors or whoever, whatever are the liabilities. So that is the part of funding risk. But one important point which I want to mark is, this funding risk is ultimately affected by the market risk. Because funding is ultimately affected by the interest rates and the market situation. So ultimately it will be market risk only in the end, but because that is a very big term. Specific answer is funding risk. Because market risk contains many other risks. Got it? So the answer is funding risk. Got it, everyone? What is the purpose of maintaining cash reserve as a part of liquidity management? Cash reserve as a part of liquidity management. To purchase the long-term assets, see, all these are the parts of liquidity. Cash reserve ratio, CRR you have in the banks. Why do we have CRR? To manage the liquidity. But what is the purpose? What will happen if I don't maintain? To purchase long-term assets, to cover unexpected expenses and short-term obligations, to invest in high risk and high return in ventures, to minimize tax liabilities. What is the purpose of maintaining CRR, cash reserve? Answer is to cover unexpected expenses and short-term obligations. To cover unexpected expenses and short-term obligations. Okay? That is the basic purpose. Got it, everyone? That is the basic purpose of maintaining cash reserve. Now, cash reserve is a separate word than cash reserve ratio. CRR is maintained with the RBI. And cash reserve can be maintained by anyone. You also can maintain the cash reserve tomorrow, isn't it? Which of the following would be wrong approach to financing working capital? Working capital. Wrong approach. Which of the following would be wrong approach? Means I should not follow this for financing my working capital. Financing short-term needs with short-term sources. Relying heavily on long-term debt. Maintaining large cash reserves. Okay, let me make this long-term. Long-term. Financing short-term needs with long-term sources. Relying heavily on long-term debt. Maintaining large cash reserves. So wrong approach. What should be the answer? And all of these, obviously. So the answer is all of the above. All of the above is the answer. Why? Why all of the above? Because see this. Financing short-term needs with long-term sources. So that is very wrong. If the long-term sources are from your own, then you can accept it to some level. If I am having my own equity and then I am using it, then I can accept it to some extent. But long-term sources are of two types. One is you take it from the banks and private parties. Second is your own funds, equity. So if you take it from the banks and use it, if you take from the bank as long-term loan and use it for your short-term finance, that is wrong. That will create an imbalance in your overall financial structure. Relying heavily on long-term debt. Again, taking the long-term loan from banks and using it for working capital. Very wrong that is. Third one, maintaining large cash reserves. I'll have huge reserves with me, cash, so that if any expense comes, I can pay it. But do you know the problem with large cash reserves? If I maintain large cash reserves without utilizing it, I will lose on the interest. Interest I am losing. If I keep full money in current account or savings account also, savings is what, 2.5%. Current is 0. If I maintain huge balances in saving and current CASA as an individual, I am in a loss. Of course, bank is in a profit, but I am in a loss. Right? So, all these three methods are wrong for financing working capital. So, which is the right method then? The right method is financing short-term needs with short-term sources. I'll write this, needs with sources. So these should be equal. That's why in our balance sheets also check. We always try to balance current liabilities with current assets. Always we try to balance current asset with current liabilities. When you balance these current assets and current liabilities, then your overall financial structure and your liquidity management works very fine. Perfectly it works. Okay, got it? So this is the answer. Correct one and wrong ones are these. A company's NSFR ratio is net stable funding ratio. This is a part of Basel III. Has declined below the regulatory minimum. Whatever is required by regulatory minimum. What is the minimum ratio? 100%. 1 you can call it or 100. So NSFR has declined below 1 or below 100%. Which of the following actions is least likely to improve NSFR in the short term? NSFR in the short term. Kindly note two words I have marked. Least and short term. Increasing long-term debt issuance, reducing short-term wholesale funding reliance, issuing new equity, selling off illiquid long-term assets. So which is of less use? Less use. Increasing long-term debt issuance. So if I increase the long-term debt issuance, see, NSFR, improve the NSFR in the short term. It is least likely. Means it will have least effect on it. So if I increase the long-term debt issuance, will it have least effect or higher effect or normal effect? Forget least. Debt issuance. Debt means what? I am issuing the means this debt issuance means I am basically giving the bonds. Okay, I am giving the bonds and taking loans from others. So will it have least effect? No, it will have a normal effect because this actually doesn't have that much effect on it. It will have a normal effect. I am giving the bonds and I am taking more loans. So that will affect my NSFR heavily, in fact. It will affect my NSFR heavily because I am taking more loans from the people. Okay. So this is not the answer. I want least, which will not affect my NSFR that much. increase in NSFR that much. Reducing short-term wholesale funding reliance means basically funding reliance, forget it. Reducing short-term wholesale funding. So if I am short-term funding, giving short-term loans to all these customers, pre-shipment, post-shipment, all these loans. So if I reduce that, what will happen? NSFR is a long-term ratio. This will reduce, this will have effect on LCR, liquidity coverage ratio, but it will not have the effect on NSFR. So this is also out. Issuing new equity shares, that is a part of capital structure. That is not directly affecting the NSFR. What is the formula for NSFR? Required stable funding upon available stable funding. Stable funding, understand this word, stable means constant money source which I am getting. Equity is it a constant money source? Do I issue the equity every now and then? No. So that is also out. Selling of illiquid long-term assets. Suppose if I sell illiquid long-term assets, so this will affect my denominator. Okay. Available stable funding. See, required stable funding upon available, that is your NSFR, available stable funding. So if I sell off the illiquid assets, so this available stable funding will reduce because it's a long-term issue. NSFR is a long-term, illiquid assets are also long-term, and NSFR is also long-term. So this will definitely affect it. So the answer means least affected, okay, because it will not have that much effect on it. So the answer for this is selling of illiquid long-term assets, okay. So least effect is this. All these will have normal effects or higher effects, okay. So least effect is selling of illiquid long-term assets, got it? Least effect. Next. Which of the following is the most effective approach for a multinational corporation to centralize liquidity management across its diverse global operations, considering foreign exchange and regulatory complexities? So, effective approach for a multinational corporation to centralize. Centralize means bring everything in one fold. Bring everything concentrated somewhere. Okay? Bring everything concentrated somewhere means it is done at a single location. Now we have this similar, see this liquidity management. For this we have in our country also we have GIFT City. There are many treasury departments of foreign banks come in GIFT City. Okay. So which of the following is the most effective? Most effective. Establishing individual treasury functions in each subsidiary. Implementing a comprehensive pooling structure with global cash management system. Investing all excess cash in a single highly liquid money market fund. Relying solely on local bank financing for each subsidiary. See this. C and D are obviously out. Okay. So in a single highly liquid fund, it's wrong. You cannot invest in a single fund anywhere. Solely on the local bank, that is also wrong. Local bank can't supply you that much money. Answer is between A and B. Establishing individual treasury functions in each subsidiary. Now see here. Here you are talking of centralizing, and here what are you saying? Individual treasury functions in each subsidiary means each country I am having a different treasury unit. That is not right. So these three are not at all useful. This is the right one. Most effective. Implementing comprehensive pooling structure with global cash management system. Okay, this is the right one. Got it? This is the right answer. Clear? Now, before going, everyone kindly join the new batches of Adda 24/7. Officer Pro batch. Join it through the app. Always download the app first and then join. Download the app. Because through that you will be getting 1% extra. How to join this? See this. CIB Officers Pro batch. E-books, mock test, online live classes, recorded sessions. You're getting everything. Okay? And mock tests are to the level of chapter wise. Per chapter you are getting. Plus you are getting full length mock test also. 10. Ebooks chapter wise. And look at this. How to buy now? Click on buy now. Put the code Y432. 79% discount plus 1% extra through the app. So 80% discount you are getting. Huge ebooks, mock test, everything. Join it ASAP. Also, you can join the Increment Mahapack of CIB. See this. Increment Mahapack, CIB Increment Mahapack. One of the best Mahapacks. Join this. In Increment Mahapack, you are getting 15 plus batches per subject. 15 plus per subject. Okay? 15 plus batches per subject. Plus, you are getting ebooks, mock test, online live classes. Everything is there. But for that, always remember, use the code Y432. Y432. Click on enter. 79% discount plus 15 plus batches plus ebooks plus physical books. Physical books also you get it in this. Plus Formula Bank. Huge Formula Bank is one of the best things. So join it ASAP. Okay? Bye from my side.